Support and resistance. Why your levels keep failing. Look at this chart. Price falls to a level, bounces, falls again, bounces again, one more time, bounces again. Now here's the question. How did traders know that was going to happen? They didn't predict it. They read the chart. And what they recognized is the single most important concept in all of technical analysis, the foundation that every professional trader, every institutional desk, and every serious chart reader uses to frame every trade, every price target, and every stop loss before a single dollar goes to work. It's called support and resistance. Most beginners hear those words and nod along, but most beginners also lose money on levels that should have held, and they can't figure out why. By the end of this video, you'll know exactly how to identify these levels, how to draw them correctly on any chart, how to interpret what happens when price approaches them, and, just as importantly, the specific mistakes that make most beginners' levels completely useless. This is the concept you build everything else on. Let's get into it. Let's define these terms precisely, because vague definitions lead to vague chart reading. Support is a price zone where buying pressure has historically been strong enough to stop or reverse a declining price move. Think of it as a floor. When price drops into a support zone, buyers who have been waiting, either adding to long positions or buying the dip, step in. Their demand exceeds the selling pressure, and price stabilizes or reverses upward. Resistance is the mirror image. It's a price zone where selling pressure has historically been strong enough to stop or reverse a rising price move. Think of it as a ceiling. When price rises into a resistance zone, sellers who have been waiting, either to take profits or to open short positions, become active. Their supply exceeds the buying demand, and price stalls or reverses downward. The reason these levels form, and keep forming, comes down to how human beings process price history. Traders remember where the market has been. If a level has been tested and held multiple times, it is no longer just a technical line. It becomes a reference point that thousands of participants are watching simultaneously. That shared awareness creates a self-fulfilling dynamic. People expect a reaction at the level. They act on that expectation, and the reaction occurs. This is not mysticism or chart magic. It is the visible output of collective human behavior at price levels that carry memory and meaning. Now let's look at how to actually find them and draw them correctly. Let's use a real current market example, because the S&P 500 right now actually gives us a textbook support and resistance setup to work with. The index hit an all-time high of 7,514 on May 14, 2026, then sold off immediately, a rejection from an extended level. And as of this recording, the most critical support zone traders are watching is around 7,200. Here's why that number matters. Go back to earlier in 2026. The 7,200 area was a previous all-time high. When price pulled back and tested that zone, buyers stepped in, then price ran higher, then it pulled back to test it again, buyers stepped in again. That repeated behavior, price coming back to a level and being met with buying, is what makes a zone legitimate support. It's not that someone decided 7,200 matters. The market itself showed us it matters through repeated reactions. Now above price, resistance sits in the 7,285 to 7,350 range. Every time the index pushed into that zone, sellers became more active and price pulled back. That's resistance doing its job. So how do you draw these zones on your own charts? 3 steps. The strongest support and resistance levels are the ones that have held multiple times, that align with a psychologically important number or a prior major turning point, and that have shown reactions on meaningful volume. When all 3 of those align, you have a level worth putting on your chart. Now here's where support and resistance moves from definition to practical chart reading. There are two fundamentally different things that can happen when price approaches a key level, and misreading which one is happening is where most beginners lose money. Buyers step in, demand exceeds supply, and price reverses. This is the intuitive scenario. Price hits the floor and bounces. But here is the nuance that most tutorials skip. One touch at a support zone is not enough information to act on. What you want to see is confirmation. Did volume increase at the bounce? A low volume touch is unconvincing. High volume means real buyers showed up, not just a lack of sellers. Did price close back above the zone, not just dip into it briefly? A closing price above support is more meaningful than an intraday low that tags the zone and recovers. Did the bounce have momentum, or did price just slowly creep back up? These details tell you whether the zone is genuinely holding or just temporarily delaying the move. This is called a breakdown. The support zone fails. Buyers are not there in sufficient size. Price closes below the zone on meaningful volume and keeps going lower. Here is why it happens. When support breaks, everyone who bought in that zone is now losing money. Their position is underwater. When price eventually rallies back up to that zone, which it often does, those same buyers are looking to exit at break-even. Their selling pressure converts the old support into new resistance. This pattern shows up across every asset class, every time frame, and every market condition. When you see price return to a broken support level and get rejected, that role reversal confirmation is telling you something concrete about the current balance of buyers and sellers. Understanding both scenarios, bounce and breakdown, is what allows you to read a chart as a map of where supply and demand have been, not just where price is right now. Let's talk about the three mistakes that cause most beginners' support and resistance work to fall apart in practice. Price doesn't reverse off a single price point with mathematical precision. It reverses off an area. When you draw a thin horizontal line and price dips one tick below it, your line looks broken, but the zone is still intact. The mistake is expecting precision where the market gives you approximation. Draw zones, use a shaded rectangle, give price room to breathe within the zone before you make a judgment about whether it's holding. A level breaks down. Most beginners remove it from their chart. It failed, it's irrelevant. But the opposite response is more useful. Mark that former support as potential resistance. Watch what happens on the first retest. The role reversal pattern is one of the most reliable setups in technical analysis, and it only shows up for traders who kept the level on their chart after the breakdown. One visit to a support zone is data. It is not a signal. The market needs to show you that buyers are actually present through volume, through closing price strength, through the character of the bounce. A single touch at support where price barely reacts and then slides sideways tells you very little. Wait for the market to confirm what the level is telling you before drawing conclusions. Support and resistance analysis is not about finding perfect levels. It's about building a map of where the market has shown clear behavioral tendencies and then reading price action against that map with patience. Let's bring it together. Support is a price zone where buyers have historically stepped in with enough force to stop or reverse a decline. Resistance is the mirror, a zone where sellers have consistently capped upside. Both are zones, not lines. Both reflect the collective memory of everyone watching that level. When support breaks, it often becomes resistance, and the most reliable version of that pattern is when price returns to the broken zone and gets rejected. That role reversal tells you exactly where the balance of power has shifted. This is the foundation of chart reading. Every indicator we cover in this series, RSI, MACD, Bollinger Bands, Fibonacci, works better when you have your support and resistance levels clearly mapped. Because context is everything. A bullish RSI reading at resistance tells a very different story than the same reading at support. Drop a comment below with which indicator you want us to cover next. And if this changed how you're looking at charts, subscribe. We publish exactly this kind of foundational analysis every week on MacroMicro investing. This video is for educational purposes only and is not investment advice. Always consult a licensed financial professional before making investment decisions